Welcome to Industry Interviews, a series where ETF Stream and its partners analyse some of the key investment trends from across European ETFs. For this interview, we partner with Xtrackers by DWS to focus on the strong demand for equal weight ETFs amid the significant overconcentration in US equities. To discuss this, I'm delighted to be joined by Olivier Souliac, Head of Xtrackers Indexing Products at DWS, Dan Capps, Investment Manager at Evelyn Partners, and Alistair Dean, Director at Stonehage Fleming. So let's dive into it straight away. Olivier, maybe coming to you first, could you talk a little bit about sort of the demand for equal weight ETFs over the past 9 months or so now? We've seen some really significant inflows into your product and other equal weight strategies. So yeah, what's kind of driving this popularity?
Yeah, thank you very much, Tom, for having us today. And yes, so the popularity of S&P 500 equal weight and equal weighted strategies overall is something that we've been seeing picking up over the course of the last 3 years on the back of course, tremendous performance in the large cap and ultra large cap segment. Also on the back of two main trends that we could see from investors, right? And the conclusions they can draw out of this large performance in the mega cap segment. The first trend is really around mean reversion and the expectation that some of that very large performance in the mega caps, especially the Magnificent Seven in the last 12 months, some expectation that this outperformance will come to an end will probably be followed by a readjustment. That's really the kind of behavior where we see there is probably some timing linked to it. And this mean reversion means that flows into this product come after a bout of outperformance coming from these Magnificent Seven stocks. The second trend we could see is a more of a kind of core readjustment. So maybe risk management type of trade where with the increased concentration that we see in indices, concentration now that we see is equivalent to that what it was back in the 90s. It's already something that we haven't seen for several years. With this increasing concentration, the growing concern that the risk spreading within their core allocation has been slightly modified. That risk contributions are more concentrated. We're looking at around 30% now of the S&P 500 that's populated with those Magnificent Seven. And clearly here, a trend towards risk readjustment in order to have probably something which investors will consider is more an evenly spread exposure within their core.
Yeah, great stuff. That provides a really nice sort of overview of where we're at right now. Alistair, just bringing you in here, what was your kind of thought process behind sort of adopting an equal weight approach at this moment in time?
Yeah, so our portfolios already have like a very healthy weight to traditional like US markets through the S&P 500. So our thought process was, how can we sort of benefit from the long-term growth of US companies, but without just creating extra exposure to those really large companies which have driven returns over the last decades? Because there are scenarios where those companies maybe don't do so well, might be due to regulation, or it might just be because they're very large companies and the law of large numbers starts to impinge on them. So we were really looking for ways to benefit from just the wider growth of US companies, but being agnostic to company size, and maybe finding opportunities which offer more value characteristics or are a little bit further down the market cap spectrum.
Yeah, so I was going to ask about that, because obviously you're sort of naturally implementing a sort of size bias there. Is that a kind of a deliberate choice?
Yeah, it was a deliberate choice. When we look at the Magnificent Seven, yes, they're exceptionally good companies, very profitable, very cash generative. But as I said, there are scenarios where they don't perform. And if they don't perform, then that's going to be really difficult for wider markets to overcome. Because if the top 5 stocks underperform, it's very hard for the remaining 495 to outperform, or to sort of see the index deliver positive returns. So, yeah, we think an equal weight offers a very good way to provide diversification whilst also keeping that long-term growth.
Yeah, great stuff. Dan, same question to you, really, in terms of sort of adopting that equal weight approach. What was your thought process there?
I think you need to return to sort of the macro outlook in late 22, early 23, where you'd just come off the largest, fastest rate hiking cycle in history. And everyone was sort of sitting on their hands a little bit, being a bit cautious as to what that might mean for growth going forward. So it was largely flagged as the most signposted recession in history has sort of yet to occur. And all through the year, we've seen inflation start to cool. We've seen growth remain robust. And that's given us a bit of confidence with regard to the US economy overall. At the same time, as we've all been talking about today, you've had the rise of the Magnificent Seven. You've had the AI-driven rally by the introduction of ChatGPT, and all the euphoria that you got off the back of that, driven the largest 7 companies to these really lofty valuations. And so whilst we were getting confidence about the US overall, we started to have concerns about really adding to our market cap-weighted exposure, which sort of echoes Alistair's comments that we had a reasonable amount of exposure to the US already, as a lot of people do. But as we were getting more confident about what we were seeing in the economy there, we wanted to add to the region without necessarily buying in at these lofty valuations. And that's where something like the equal weight really allowed us to implement that view without buying too much into an already concentrated market.
Yeah, really interesting. And just going on from that, obviously, it's a good way to dial down Mag 7 exposure. But obviously, we've seen NVIDIA, post some seriously good numbers, deliver some good outperformance recently. So what sort of environment would you need for the equal weight trade to pay off over the next kind of 6 to 12 months?
Okay. Without trying to be sort of too doom and gloom about this, it would be, in the event of a bubble bursting and those more growthy names selling off. Rightly or wrongly, some people have made comparisons back to sort of the dot-com crash that we saw in the early 2000s. And if you actually look at the performance of the equal weight index relative to the market cap weighted S&P at the time, market cap weighted S&P was down about 25% when the equal weight index was up 20 for the same time frame. So we have shown it provide that diversification benefit before. In terms of timings, we've seen as you said, NVIDIA post great numbers, and this rally has continued. So that's why we maintain our market cap weight exposure, why we still want to participate. Should that rally continue, but the equal weight index gives us some diversification and just protects, as I say, if we do see that bubble burst.
Yeah, really good stuff. Olivia, what's your take on that? Is equal weight the best way to sort of dial down that Magnificent Seven exposure?
It's a very simple solution to a complex problem, that's for sure. Now, there are many solutions to actually underweight the Mag 7 within a portfolio, but within the ETF space and within the indexing space as a whole, if you look at other options that you could have to do like sector neutral approaches, to look at other ways to weight your index, actually you'll end up with more complex strategies that may be less representative than an equal weighted strategy. So if you look at the sector distribution, for example, of equal weight, of course, it's a different one from the S&P 500. However, you remain relatively representative of the real economy in the US with an overweight in energy, an underweight in IT. So something that's probably more representative of total assets weighted type of indexing, which kind of resonates pretty well. And also, if you look at we mentioned like thematic exposure. If you look at the thematic exposure within the S&P 500, it's a pretty large exposure, right? You have more than 50% of the S&P 500 stocks that are actually already connotated with some kind of thematic exposure, being autonomous technology, but also rising consumer behavior. If you go past that and go to an equal weighted type of strategies, all of these different, thematic exposures that the S&P 500 market cap weighted has, they kind of almost vanish. So you end up with something that is probably also representative of the more real economy, maybe, but also something that is a very good, let's say, building block for you to build exposure to, for example, AI as a theme separately, to your core. And that really kind of frees up some space as well for a parallel portfolio construction with thematic instruments. So is it the best? Is it not? Difficult to say, but it's a very simple solution to a complex problem, and it's a very convenient solution because it helps you in your portfolio construction, and also it's a very transparent and very easy to explain.
Yeah, great stuff. And Alistair touched on, the factor exposure that's slightly different from when you go sort of equal weight versus market cap weight. Olivier, could you sort of dive into that a bit further and talk a little bit about the sort of factor exposures that you bring in with an equal weight approach?
Yeah, so on top of sector biases, of course, you land factor biases. Clearly, you will not be as much growth exposed as an S&P 500 index, so that's for sure. You will have around 0.2 standard deviations, which is at the limit of something that is material. If you look at a value factor index, it will have around 1 standard deviation exposure. So you'll be at 0.2. So you do have some material value exposure, but clearly whether you're the most materially exposed is the low size factor, right? With 0.5 standard deviation. So that's pretty material, and that's maybe also what you might be looking for. And clearly it resonates pretty well with investors' behaviors, which converges towards looking at getting exposure to the equity risk premium, and not so much to single stocks. And where going into the lower size segment also means that you go into the breadth of what equity risk premium can actually bring you. So this averaging effect that you have with the equal weight is also some way to capture equity risk premium in the months to come. May the returns not come anymore from, for example, the Magnificent or 6.
Yeah, great stuff there. And Alistair, obviously we've touched on the sort of US market, but is this a global issue that you're looking at? Are you seeing overconcentration in other areas of the market? And yeah, sort of how are you tackling this if that is the case?
Yeah, it's a good question, because the concentration in the US market gets a lot of attention, but when you look at, say, the FTSE 100, the FTSE 100 is actually way more concentrated than the S&P. I think it's like 45% is in the top 10 companies. But I think it comes down to understanding what you're actually buying. Like, you have to look at, say, if you equally weighted the FTSE 100s, you have to be aware of what companies you're betting on, what risks you're taking within that. I think the advantage maybe with the US is just the sort of dynamism in that market. It's much more capitalist than quite a lot of the other markets, a lot more shareholder friendly. And generally we find that leads to better results than, say, trying to equal weight in some of the other regions like emerging markets or Japan or some of the European countries. So that's why we favor the S&P 500 equal weight as opposed to any other region.
That's interesting. Olivier, would you add anything to that from a sort of taking a global perspective to equal weighting?
Yeah, well, absolutely. The problem of index concentration on single issuer is a problem that is common pretty much in every market, and absolutely, if you look at MSCI Europe, especially over the past, actually MSCI Europe was more concentrated than the S&P 500. It is reverting now to a certain extent, but not completely. So if you look at, for example, the breadth of an index by its effective number of names, clearly you see that the breadth of indices, not only in the US, has gone down, meaning that concentration has gone up. Now, I completely agree with the fact that the US market is something special, that is more investors friendly, that really we think of when we talk about equity risk premium, because you could expect from the broad market a higher premium in the US, that's for sure. So we've seen demand for indices that are less concentrated throughout the developed market equity space, especially. And that's alluding to what I was saying at the beginning, right? Equal weighting is only one solution, and it is pretty compelling in the US market. Is this the right solution for other markets? Is really an open question mark. And index providers are indeed working very actively within that space to address concentration issues outside of the US.
Yeah, good stuff. And then just to wrap things up, in terms of a quick outlook, Alistair, maybe coming to you first here, how do you see kind of equal weight S&P 500 ETFs playing out over the next 6 to 12 months?
Yeah, thanks, Tom. It's a good question. I'd say 6 to 12 months is probably too short a time frame for us. We're looking out 5 years plus when we make investment decisions. But I can see reasons why the S&P 500 equal weight can do better over the next 6 to 12 months. And the two main ones I would point to are, one, the Fed's does look to be at the end of its rate hiking cycle. And we're looking at probably 3 or 4 cuts this year, which should be better for some of the smaller companies within the market. And you're also seeing some improvement in economic data. We know the US economic data has been exceptionally strong over the last 12 months, but one area of weakness has probably been in manufacturing. And we have seen that start to tick up in the last few months. And we're also seeing that in some of the other global regions as well, like in Japan, in the UK, did enter technical recession, but are coming back. So that should play into the hands of equal weighted positions, which do have more exposure to the likes of industrials, where you get a lot of the reshoring theme in the US. The same with materials, same with utilities, and also real estate as well should benefit from interest rates coming down.
Yeah, great stuff. Dan, would you add anything to that?
You know, I'd echo those comments and mention what I said before about the Fed continuing to tread this narrow path, this Goldilocks scenario of inflation becoming under control, but growth staying resilient, means that we continue to have, you know, a degree of confidence in the US economy and want to maintain our exposure there. And so we feel like the balance of equal weighted exposure and market cap gives us a nice complement of each. So the scenarios in which that we see the equal weight doing particularly well is where we get this broadening out of the rally that we saw, particularly in the first half of 23. And we did see that come in the last final months of last year. So if we continue with that trend, then we would expect, the equal weight positions to be rewarded. But at the same time, Tom, you can't look past, some exposure to things like NVIDIA, which are really driving the markets at the moment. So we continue to be balanced across both.
Yeah, really interesting. And then Olivier, just to wrap things up, obviously you've seen big flows into XDEW recently, your equal weight product. How do you see things playing out over the next 6 to 12 months?
If we see what's going on now, which is some persistence in the situation where the Magnificent Seven remain one of the driving forces in benchmark returns, and coming back to the observation that I started with on risk management versus mean reversion, clearly here we'll see some risk management flows going further and driving further inflows globally. So we're pretty optimistic. Also, this trend really driving the establishment of an equal weight benchmark within investors' cores, because it's not necessarily an easy step to make to change within your core the allocation from market cap to something else. And clearly the risk management aspect of that is probably going to be a driving factor of flows in the months to come.
Good stuff. I think that's a great point to end on. I want to say a massive thank you to Olivier, Dan, and Alistair for sharing their insights with us today.